Imagine you sit down at your computer every morning at 7:30 a.m., trade for 60 minutes, and walk away after catching a massive move, done for the day. Today I'm going to show you a simple, repeatable pattern that helps you spot high probability reversal areas, allowing you to get sniper entries, getting you huge reward with a little bit of risk. If you stick to this simple strategy, your trading will drastically change. Now there's two key things that I use to easily find where these areas are. Otherwise, it's really hard to know exactly in the market where you can cleanly enter in and where it's gonna have a massive move in that direction. And the first one of those is properly identifying supply and demand zones. It's super easy to go on any chart and try and look at every little reversal area the market has, every swing that it has. And so how do you properly find the correct supply and demand zones that are more likely to have a drastic move off of them? The way I do this is I boil it down to a few simple steps. The first thing I like to do is we'll stick to the extremes. If you look at just these swings in the market has all these back and forth swings, any asset you look at. And the biggest way to capture a massive move is either shorting off of the extreme highs or betting long off of the extreme lows. Trying to trade these little middle areas is so hard to become profitable at, and you're not gonna get high risk to reward ratio trades. The next thing is using a zone instead of just a straight line, because if you look at it, every time the market comes up into this area, it bounces in a different spot. It roughly bounces in this area, but it's never an exact science. If you have a specific line here, well, you might think, oh, it's broken past, and you stop watching for the day, or it reverses too soon and you don't take a trade. And so treating things like a supply or demand zone is extremely important. Now, the next thing as well is I like to look for 2 touches in these levels before I confirm and start paying attention, because otherwise it's potential that you are in a, let's say a crazy big uptrend like we're coming right now, and you start saying, here's a swing up, a down, okay, so I'm gonna think of this as a level, and you try and short here, and instead it continues higher. And so that's gonna help you avoid getting in or trying to take trades in the wrong areas. It can take a lot of practice to get these zones. Now, knowing the correct zones to pay attention to can be really tricky sometimes, and so I actually have an indicator that's free that will help draw the important zones of where to pay attention to and where to look for reversal trades off of. It helps you kind of avoid that noise in the middle, the not so good levels, and when the market kind of gets to extremes, it helps you pay attention to those areas that are important. Now, the second thing that I use to spot clean reversals in the market, you can see here, we're looking at 15-minute chart of gold, and it's actually, I have that indicator that's drawn a big supply zone down here. And this is actually a trade I'm currently in right now. But why I got into this was the market had a big move into this level. What I've noticed over time is if we just zoom out looking at this, is any time the market has kind of a big move in one direction like this, that's very drastic in one way, is the market will always give that back up. You can see right here as well, the market has a big move up here, it sells off. Big move up here, it sells off. And it's because if you look at it compared to the chart, and the big thing with this is you'll notice, see the candlesticks here are really, really big compared to what it was doing before. So it was in this little uptrend. It actually had a micro little big move up here and then a pullback. And then here it had a bigger one and it continued. It had an even bigger one and it pulled back. And the reason why this works is because the market likes to move in a methodical trend where it has moves up and moves down. And if it gets too far in one direction, it has to correct that. And so here is a great example where it's moving down in a slow, methodical trend down, and then all of a sudden it starts to go crazy here in one direction. And so it gets overextended. I like to think of it as an exhaustive move or overextension. Think of the market, it's just kind of cruising along here, and then all of a sudden it starts to sprint in one direction. Well, it has to take a break And so it causes the reversal and the market to snap back in the other direction. And so at that point, that's where you want to get in. You want to get in here where you see the market start to slow down, exactly like this trade I took this morning. If I go in actually a 5-minute chart, is you'll see the market did a big move down here, lots of volatility. It started to slow down and then it made this double bottom right here. And that's when I jumped in right here, and then I bet that the market was going to go back up. And from there, I like to, see if it will give this move back up that it had, because if you look at all of these past moves where the market kind of gets overextended in one direction, usually it will give that move it had back up. And that's where the easy money is. Now, sometimes right here, you can see it did have a big move up and then it gave it back up and it did continue even farther. That can totally happen. And that's kind of when you get a massive high risk reward move where you can get 10x, but those don't happen all the time. And so that's how you can start to pick either bottoms or tops. And there's a super simple way to do this using what is called a fair value gap indicator. I have made kind of my own custom version for it that helps kind of weed out some of the bad ones or some smaller ones. But if you look at it, it helps you easily identify when it's overextended by making these boxes. You can easily see, okay, here it's overextended, over here it's overextended, and it's likely, when you start to get a reversal, it reverses that. And same thing with the one today is the market had a little overextension indicator here and it pushed up higher. And so it's basically given that back up. And so that's why at the moment I have a pretty tight stop loss on it, because I think, well, either if it keeps going, great. But if it pulls back, I kind of want to get out because I think the easy money and the easy move is finished. If you want to trade on this platform that I'm using right here, it's called NinjaTrader. You can get it for free in the description below or this QR code. And so the last big trick about this is how do you actually know when to actually enter? If I pull up a risk reward calculator here, depending on where you enter, you can, if I entered in all the way up here and have my stop loss all the way up here, the market has to move all the way up here for me to get 1 times my risk. But if you move that all the way down to here, that same move is 3 or 4 times your risk. And so this makes how you enter into these trades extremely important. It's a balancing act between having too tight of a stop loss to where, if it works out perfectly, you could get, with a tiny move, you could get a 20x. But in the reality of trading, that's really kind of just a fantasy. Trying to go for something more reasonable, like 3 or 4 times your risk, is a lot better. 5 is great too. Often I kind of try and just hit kind of 2x as a easy target, and then if things go crazy, I get more. When it comes to trading, the way you make a lot of money is your sizing. I'm risking $1,000 per trade a lot of the time. This one's only risking $500 per trade. But when I'm big size, it'll be 1,000 or 1,500. And then if it goes, 2x, well, hey, it's $2,000. That's plenty of money. I don't need to be making a 10x trade at $200 of risk to make that, because that's a lot harder to do. And so let me show you a couple ways to do this to help maximize your risk reward ratio. And so first off, big picture wise, I always like to look at on a 15 or 30 minute chart of where are these major levels, where are the major reversals gonna happen, when the market comes down to these levels that I wanna be paying attention to, because bigger picture allows you to focus on kind of the extremes of catching kind of a top of a massive potential move. But if you go down to a 5-minute chart, you're able to get a more accurate entry. And if you even went down to a 1-minute chart, you could have noticed that, well, the reversal looked like it was, there was kind of a double bottom right here. And so even then, the reversal, there could have been a signal to jump in long right here. And that would have been way before my 5-minute signal. And that's just, a comfortability thing for me. I like trading a 5-minute because it's a little slower, but you can totally trade this on a 1-minute. And if you did that on a 1-minute, instead of being up for me, I'm up 1.5 times right now, roughly here. Well, you would have been up 1, 2, 3 times your risk at that point. And so you can see it looks like it just stopped me out there, and that's totally okay. Not every trade is gonna be a massive runner and a massive home run. The idea is that you are looking for these levels over and over time, and that using this strategy will help you target kind of these lows and reversals. The whole idea is finding something super repeatable like this and trading it consistently. Now you can get these 2 indicators for free in the description below. They help make it way easier to actually just kind of sit and wait for the proper areas to show up instead of constantly trying to second guess. So I highly recommend checking those out. And if you want a more detailed walkthrough of this strategy, how to consistently execute over time, check out this video right here.